Hi, everyone. I hope you're having a great weekend. Overall, the stock market did not have a great week at all. Our market models have been under a whipsaw pattern lately, which is not a big deal, as it's to be expected here whenever you sell off on huge volume, rally on low volume in V-shaped manner, so none of this shocks me. However, after Thursday's session last week, I tell you what, it looked good. We had a lot of great looking stock charts. The indexes retook the 50-day moving average on strong volume. It looked really, really good. I tell you what, it wasn't bad at all. And on top of that, on Friday, we had the New York Stock Exchange advanced decline line break out to new highs. And I tell you what, going back to the beginning of the history of the advanced decline line, there hasn't been one time that this index has hit a new high and then we've topped out. But I tell you what, I made mention at the beginning of the week, wouldn't it be funny, a big FU of the market, if the New York Stock Exchange advanced decline line hit a new high and this time around we topped? It's kind of just a talking point, but my God, it was prudent. As this week went on, we came right back down below the 50-day moving average on heavier volume. Very, very, very strong volume, culminated with Friday's session. The NASDAQ not only broke the 50-day moving average, but attempted to start to get back above it on Thursday, and on Friday, immediate rejection. And that came with a fake out long signal on Facebook. It looked like a really solid 2-day combined long signal at the 50-day moving average. That's a 75% cut loss. Our final cut loss level, mine, is going to be below the 75.63 level. But the fact that it did what it did following Thursday's session is another huge tell. New York Stock Exchange, boy oh boy, when it failed, it really failed. And I tell you what, that was confirmation of the previous weakness that we had in the other indexes. The Russell 2000 also came back below its 50-day moving average. And this time around, I was going to tell it, the biggest tell that maybe this bounce attempt here, in hindsight now, it's obvious hindsight, wasn't going to work. The last time we bounced, we were at oversold, and our MACD, stochastics not shown, but it also, and TSV all started to trend higher. When we started to bounce here in December, we had TSV trending higher, MACD, and stochastics, as you can see, also. This time around on this bounce, though, TSV didn't bounce higher. MACD didn't bounce higher. Stochastics really are going nowhere. And that can be seen also on the NASDAQ. The same thing. The NASDAQ had a nice bounce of TSV and MACD in October. December, not so much. Once again, almost of a bigger hint to come. But on this most recent attempt, it was even worse, as less of any kind of positive divergence showed up. And the NASDAQ now seemingly failing is just not good. Now, the Dow Jones Industrial Average is leading all the indexes on the downside. This index switched to a sell signal on the 28th as it violated its January lows here, which was also happened to be at the 100-day moving average. So not only did we violate those lows, but we tried to test the 100-day moving average, and we have failed on even heavier volume. So the Dow Jones Industrial Average looks sick. It's already under a sell signal. What will change the NYSE to a sell signal? A close below those January lows. Same with the NASDAQ. Same with the Russell 2000. Same with the S&P 500. And with all this action, I'm going to add to my SDOW, my hedge in the Dow Jones Industrial Average. You can see TSV and MACD is confirming this price action lately. Also, SPXS, now that the SP 500 is weakening, I want to go ahead and take on this hedge. So 2.5% of the account capital is going here. And with the NASDAQ looking like it wants to switch to a sell signal, going to do 2.5% of the account value in there too. Now, oil did bounce. What is it? OilX.X? I can't even. XOil.X. So oil did bounce heavy on Friday, which is a potential positive sign, especially with MACD and TSV confirming. But the big sell-off in oil, along with bonds continuing to rally, look at the 20-year bond. I mean, it's just ridiculous. It's getting pretty crazy. And the super low bond yields could be indicating that things are extremely, extremely, extremely ugly here, and that we're about to have a nasty, year. Don't forget, this is only the 8th year ever that the market has been down to start the month of January, and all previous 7 times we finished lower by year end. All previous 7 times led to a recession. The last time we closed down in January is 2008, and we're doing it again. The average return annually for those years is negative 14%. So remember all those Hindenburg omens that we got in December in the stock market? I think we got like 6 in 7 days. No more QE, the bond yields crashing, the oil crashing. The bulls are outrageous. The NAAIM asset management shows that it's like 90% long. AAII bulls are at 44%, well above 35%. which is starting to get, heavy, but at least it's not at 50%. And the II bulls are still at 53% off their 65% highs, but the bears are still under 20%, right around those 1987 levels. So there's just no bears out there anywhere. No bears in NAAIM, no bears in AAII, no bears in II. So that's another problem. Then you have the Greece recent turmoil, and then you have deflation across Europe. And then more importantly, let's look at some of our important stocks. Look at GoPro. Could it hammer out a bottom? Yeah, man, but I'm going to go over that in a minute. But look at the current chart. Look at Alibaba. Look at that bounce attempt on Thursday get rejected on Friday with a big intraday reversal. Our recent long in Facebook. Look at LinkedIn. It just can't seem to work its way through that 50-day moving average. Look at UPS. Look at FedEx, what I believe to be the two stocks that really tell you how the economy is doing, because everybody's sending mail everywhere. You got FedEx and UPS looking really, really bad. Then you got the railroads, UMP, starting to look like it wants to roll back over after failing to make new highs. And then look at the banks. Look at Goldman Sachs. Couldn't retake that 200-day moving average. Look at Bank of America. Look at Morgan Stanley. Look at JP Morgan. Look at Wells Fargo. I mean, we've got some ugly looking stocks out here. There's the financial XLF. Look at home builders recently. I mean, that chart, that looks like definitely a topping pattern if you ask me. And then you look at the big cap stocks like Yahoo, Priceline, Google. Wow, that's a good move, Google, but still the overall downtrend's clear. Microsoft, Intel. And you can start to see the same pattern in all of these stocks. And Apple following its nice earnings, it's moving its way higher, but it looks heavy, like it looks like it wants to reverse, attempting this new high move. So overall, the market looks sick. I really advise extreme caution here. I have some partial sells and full sells. Most of them were hit intraday for me. And once again, the most important thing that I have to do is I got a lot of long positions. I'm more long than I've been since 2007. Huge tell to me that that should have been it. But the bottom line is, without any great new long setups, I was forced to take all these mediocre setups with tight stops. If the market would have taken off and I wouldn't have taken any of these mediocre setups, just like in 2009, whenever the initial market rally caught me, because I wouldn't take the mediocre setups, I was waiting for my perfect charts that showed up every year, even in bear markets going into 2008. I got caught behind and I underperformed in 2009, and that's continued all the way into 2013 when finally I outperformed. 2014, similar situation, finally beat the market by over 2 times. But this year, once again, the market though has got me beat. The market is down right around 2% for the year, and that's exactly what I'm down for the year due to over trading. My commissions don't cost me that much on the account balances that I run, but still, all the trading in and out and all the small losses, they start to add up. So once again, we got to raise those sell stops. And it's true, we might be taken out, we might reverse, but the bottom line is, even if we do reverse, we're going to need to see some huge price moves on huge volume to the upside, or else we're going to be in trouble short term. It's crazy to have a market look like this near its new highs, and I'm not going to call a top at all yet until I see an inverted yield curve. And just to go show you what that looks like, here's our current yield curve situation, 3 months going into 30 years. You can see with the trailing 6 months, you can see that we've come down everywhere, but we're not inverting yet. So this short term isn't rising and flattening out this line. So until I really see a flat line, I don't start saying, oh yeah, we're definitely screwed. But with all the high valuations and all the recent turmoil, it's definitely time to take caution, just in case we do have a steep move down, at least back to the 2007, our breakout levels at the 2007 highs. But once again, look at what the yield curve looked like in 2007. But it might be totally different this time with our yields so low. But the bottom line is, caution is advised here. I'm not bearish yet, but my God, I'm extremely nervous here. And I tell you what, if we break below the December, January lows, there's no doubt we test the October lows. And then it'll be up to see what the market wants to do there. And even if it does bounce, it's going to take a while before we have some nice charts again. It's not like we've had any even since the end of October. It's not like we had any during the year 2014 either. 2013, the end of 2012, and the end of 2011 only gave us a few. So it's been slim pickings for quite a while, guys, and that's indicative in the current market environment.